Hello, my YouTube friends, and happy Saturday. I hope you're all doing well. I hope you like my Rockies jersey. I just got back from first day of Miracle League. I think I wore it in my short the other day because we had a meet and greet. It's this really nice charity event. We participate. My wife and son and I are coaches of one of the teams. Super cool. Had so much fun. Anyway, that's not what we're here to talk about. Um, I don't know if I messed up a little by doing a midweek one because I want to get back into the yield curve and what I see going on with the Fed cutting 50 basis points and how I think that'll impact the markets. We'll also talk about some stock tips in the housing market as usual and see what you guys think. So stick around, should be a really good video this week. Good morning. My name is Adam Kahn, and this is Investing with Adam K, or the Rational Investor, or really whatever you'd like to call me, even if it's some bad name, I tend to respond. Hope everybody's doing well. I hope everybody had a good week. I really hope everybody are hitting market highs in their portfolio and doing well and continuing to save. As always, this is not investment advice. I overstate it, I get oversensitive to it. Please reach out to your own financial advisors, do your own research. Don't listen to me. I'm just sharing what works for me and use this for entertainment purposes. But what a great week. I mean, the Fed cut rates 50 basis points, which was a little bit of a surprise to me. I know the markets were kind of predicting it, but I really thought that the wiser route to go was to cut a quarter and just keep cutting a quarter at a time unless something changed in the data to be able to make adjustments from there. Because that way, if things broke or things got worse, gave them the ability to start moving quicker and cutting a half or even three quarters at that point instead of just using up your ammunition in the beginning. Now, I do want to show, like, let's start out with, hopefully you guys can all see it. I took a picture. I'll do a picture in a picture. This is a normal yield curve. This is an inverted yield curve. So that's what people are talking about, and I'll explain what that means as we move along. Because I know in the news we're hearing a lot about, the yield curve uninverting. It was in an inverted state, and as the Fed's been cutting rates back down, it started to uninvert. And as I predicted, all the doom and gloomers, they're talking about how every time the yield starts to uninvert, we go into a recession. That may be true. And I hate to be the guy that says, well, this time it's different. But it really is different because the reason that they're not cutting into problems. Typically, when the Fed is cutting rates, it's because some problems emerged and they need to cut rates to stimulate spending to help catch the economy from faltering. We aren't really in that position right now. It's more that they over raised rates to stop the inflation from getting out of hand. This stops spending, it creates a strain. Basically, inflation is too many people flocking on too few goods, driving prices higher. Well, the way to stop that is make money tighter, push the interest rates higher, and make it harder for people to afford things. It sounds terrible, but that does slow inflation from getting out of control and working a different direction. Well, they over raise the rates to try to stop the markets from getting ahead of themselves. And I don't mean just markets, but even grocery store and everything else. Inflation has subsided, which now gives them the ability to start cutting rates and bringing that back to a normal position of where the Fed funds rate should be in relation to where inflation actually is. That isn't the same reason as cutting because you're having problems in the economy and you're trying to catch up because the sky is falling. Normally that's what's going on when the Fed's cutting rates. Right now, GDP is just fine. Companies' earnings are still doing well. The economy's still flowing, and they're cutting it because, well, the inflation being in control much better than it was before, and they see some concerns about unemployment. Now, the one thing that people could point to is unemployment tends to be at the end, and generally that's the last portion that can push and tip the economy into a bad position. I just really don't think we are right now. I think what you see people complaining about on YouTube and everywhere else is life is not so simple. And we really had it good for a long time. And then even during the pandemic, when they were giving out money to not work and cutting interest rates down to zero to help not just spur the economy, but people could refinance and be able to get really low interest rates and potentially even borrow off of their homes and things like that to keep driving the economy when they didn't know what was coming. I do think they were a little late to be to into the cycle to start raising rates. I think you guys know I do mortgages, and I remember at the bottom of the rate cycle saying, I don't understand why they're holding them so low for so long, but maybe they really were giving an opportunity for people to do what they did and refinance and get exceptionally low rates. I don't know, and I think they may have just been late to the party as well and not seen it the same way because sometimes the data is late. Either way, I recognize they might have been a little late to raise it. They did raise it too far, and now they're coming back in. As always, there could always be a black swan event. There's tons of things going on, whether it's Russia and Ukraine, whether it's Israel and the Gaza, and even going into Lebanon now, or even if you want to look at China and what's going on with Vietnam, the Philippines, and they're even kind of pushing their limits with Japan, from what I've seen. Now, any of that could, and Taiwan, any of that could spur into bigger problems and cause issues with economies and everything else. But to be fair, there's always noise in the background. And I don't mean it as it's just noise, but there's always things looming that could happen that could become a problem. But the earnings have been good. The economy is chugging along. Nobody enjoys inflation. Nobody likes that things cost more, but that's going to cause the slowdown that the Fed was trying to create. If we go out a little bit less and maybe don't go out to dinner every night or whatever it is that we were doing before because things cost more money now, well, that'll even itself out to you have the right supply and demand so that you aren't having too many people flock to too few goods. The one thing I worry about in the US is the exacerbation between, did I say that right? Boy, I hope so. Between the really wealthy and the rest. I mean, that top 0.1% is so beyond wealthy that I do worry about everybody else having a bit of a problem with this disparity of, rich and poor and where people lie in the chain. That doesn't mean there isn't still great opportunity and that working and saving and putting away is not a good thing. What I don't really like about the gloom and doom videos, and yes, I'm talking to the ones I watch that I like your channels, but I don't like the message that it sends, is because not all, but a lot of the people in the comments, I think they put themselves in a corner of not saving or not doing what they need to do to put themselves in a better position because it's much easier to just blame your boss, blame the government, blame somebody else that you won't be able to get out of this rut. And then you end up staying in that rut instead of looking for solutions to get yourself out. Now, if you want to be inspired a little bit, read Rich Dad Poor Dad, or even listen to it on YouTube, which is what I call reading at this point. It's got some really good tidbits, and I don't take all of it and live to it, but I really think the advice about looking for a little bit of advantage and or a different way of looking at things and never seeing no as an answer or you can't do something and changing it to how can I do that is really important and a really good way to look at things. Like instead of saying I can't fly first class, okay, what do I need to do to be able to afford to fly first class? How can I change? What can I do to put myself in the position to do the things I want to do instead of this simple, I just can't do it, it's out of my reach? Because I don't think anything is out of anybody's reach. I do think, myself included, we all get tired. We want to slow down. Maybe things get in front of us to stop our ability to see what we need to do, but you need to push ahead and do that. I also think that financial literacy, which he talks about a lot, is super important because schools tend to teach us math, science, English, social studies, and not so much financial literacy. They're beginning to implement some of it, but even the parts that they implement don't seem to be the right way that at least I would suggest teaching it. These stock challenge classes that they do. The families came to me talking about maybe we should join the stock thing at the school. I can't stand those stock challenges. Giving the kids a certain dollar amount to fictitiously invest in a competition to see who does the best teaches totally the wrong skills. It's teaching gambling and making a bet of hoping one does outrageously better than another. you're almost better off buying the worst things and hoping that you just get lucky with the timing than actually creating a good portfolio and learning about the stocks that you're buying and what you should look for in a company. Now, I do think you should understand price to earnings ratios, market cap, the revenues that are coming in, the industry that your companies are in. I'd be a little careful about overanalyzing because what ends up happening is you miss good opportunity because a lot of the best companies are going to be overvalued. And a lot of the ones that are struggling are going to be the value stocks because they're on sale because they're not doing so great. You want to have an understanding and be able to articulate why you think the companies are going to outperform versus others. What is it that you see in Amazon or this one or that one? Giving a fictitious 50,000 or $100,000 account and letting them buy some penny stock to see if they get lucky and that's the one that hits really doesn't prove anything or learn anything for the kids or teach them in terms of getting better about having financial literacy. There should also be some classes that teach it about houses because one of the great things they talk about in the book that I liked at least is that your primary residence in the house you live in isn't necessarily an investment. You're living in the home, you're using it, you're spending money to keep it up. It's not generating income. Learning what assets are and liabilities are and really having a good grasp on that, I think, is really valuable. And I don't think that really gets across unless maybe you study accounting in school and do those different practices and get to do an asset and liability chart and see what the differences are. An investment home is, of course, an investment or an asset, and then being able to do the math to see if it's going to cash flow, what your expected return on it is. And to that point, what he talks about is in his market, which is real estate, and for me in stocks, there are always bargains. If you look hard enough, you will find things that are on sale. Now let's get back to the yields. And I'll show this a little bit, and I hope I do it right. You see how wonderful my charting skills are, and I'm an unbelievable artist, as you see as well. But what I'm pointing to here, the line at the beginning, this is the Fed funds rate or the overnight lending window. When they talk about the Fed raising or cutting rates, no matter which chart you use, all they're referring to is the overnight window. It's where banks can borrow today until tomorrow overnight against anything that they owe. And it's an open window to the people who are able to borrow and lend there. And the even though we show a specific number, it does fluctuate a little based on the price where they're able to trade. When the Fed raises rates, that'll impact the other bonds, but it doesn't mean that they automatically change. When the Fed cuts rates by 50 basis points, the only thing they're cutting, let's look at this one, is right here. They're cutting this part of the curve. Now, what happens outside at the end is dependent on markets, which are fluid. One of the things that people have trouble with, especially because I do mortgages, which I mentioned earlier, is when the Fed cuts rates 50 basis points, that doesn't mean that mortgage rates drop a 0.5%. Like if it was 7% yesterday and they cut rates today, that doesn't mean your rate is now 6.5%. Because first of all, they're not cutting the interest rate. Second of all, they only cut the overnight lending rate. That had nothing to do with mortgage-backed securities. And then on top of it, the companies, the investors, the banks, the ones you've never heard of, and then the ones you've had that are the ones actually selling the mortgages to the people coming in and getting them, like Wells Fargo, Chase, JP, well, that is Chase, Goldman Sachs, all of them. Do you think they're waiting until the Fed acts to actually trade their markets? Or do you think that they're trying to predict what's going to happen when that happens and be ahead of it? So on the day that the Fed actually cuts rates, usually they've already put on the position. And more times than not, if the Fed cuts rates that day, rates typically get worse on the mortgage because they've been buying up the bonds in anticipation and putting on the right positions before the day of the cut. In fact, from what I see, if I were to guess, and this is, I don't know because markets are fluid and they're always changing, My guess is they've already priced in the next 6 to 8 months worth of Fed cuts. That mortgage rates are already where they should be for what the market's going to be come June of next year. Maybe they improve a little bit by then, maybe they get a little bit worse, but you probably don't see it change a whole lot. And what we're finding is as the Fed's cutting rates, the further out of the on the yield, which is what they're talking about, the yield uninverting, it's going back to this normal yield curve. Why? Because the Fed is cutting the rates here, but on this end, which was inverted, you're not seeing this staying inverted. They're cutting here, and this side is not falling the same way. Well, why is that? Because the interest rate that people are getting on a 10-year bond and a 30-year bond is probably accurate for where Fed funds and short-term rates should be, not where they are. The Fed artificially pushed those rates too high. Well, the 30-year bond didn't follow with it, neither did the 10-year. As they're bringing that front end of the curve back down, well, the long end is staying elevated because it isn't going up. Forgive me, I'm kind of saying it incorrectly. They're bringing the front end down, but the back end isn't moving because it's finally getting in line on that front end. They're finally bringing this down to be where it should be, and this is in the right spot already. I don't really see mortgages changing all that much because the supply and the demand for the long end of the curve seems to be pretty accurate for where the market is. What happens is, think of yourself as a lender. And I don't mean you're lending on a mortgage, but think of the bond market as if you buy a 10-year bond, you're lending that money to get paid a certain interest amount. If you're lending for 6 months, same thing. You're buying a 6 month treasury or CD. You're lending that money for the next 6 months. Let me ask you a question. If you were lending me money for 6 months and demanding a percentage rate versus lending for me at 10 years, would you typically want more money as a percentage on the 10-year or on the 6 month? That's why a normal yield curve looks like this. Typically, the longer the time frame that somebody lends, they want to get paid better. Well, when the Fed rose the rates too quickly, the long end went up, but not very fast, primarily because the Fed was artificially raising it to get ahead of yields, to slow inflation, to get ahead of where the rates really are, which is why the long end lagged. Now that they're reversing the other way, well, the long end is probably in the right position of where it's supposed to be, forcing that yield back to a normal yield curve. It's a really great way for things to do it. And then the way that the Fed can manipulate the long end is they ended up having to buy some bonds to support the markets and stop it from crashing. Well, they've been unwinding that position and selling bonds. When somebody sells bonds, they push the price lower. Lower prices means higher yield. So if they're able to lower the front end of the curve, continue to sell off their balance sheet, which is what people are talking about, which has some of the products on the longer end of the curve, well, they're pushing the front end down. They're selling the long end, which is keeping the rates up, back to a normal yield curve. As long as the market doesn't collapse, which, again, I don't see it happening, earnings are just fine. I understand the news about people losing jobs and inflation and everything else, but it seems like things are chugging along. And while we all complain that it's too expensive, things are doing well. So if they're able to continue to cut on the front end and sell off their balance sheet and the market not collapse, what an incredible job they've been able to do. And while all the gloom and doomers are pointing to the data of when it uninverts and when the Fed starts cutting, and this is what happens, and they scare themselves out of the market, well, thank you for keeping yourselves out of the market until it's gone too far. So hopefully I can sell to you when you think it's finally at that it's just going to keep going and it's gone way too far. The one thing I would keep an eye on in general is that we don't have a melt up. I would be concerned if we see over the next couple of years the stock market have like 30% returns and just what I call melt up. If you see it double over the next year or two, and really go crazy, I would be a little cautious of that, that it goes too far and has a big crash at that time. Again, this is not financial advice. This is just me sharing my opinion. So you ask, if I don't think mortgage rates are going to come down, what does that mean for the housing market? What I'll tell you is pretty much nothing, other than you need to do the research of your particular area, because markets for real estate are super localized. When I look across the country, because I like to, Florida looks like it really could have some great opportunity. I'm keeping an eye on it. Between what happened with the HOAs and their insurances going up a lot, you're now also seeing single family homes come to the market, and there's a lot of new inventory in Florida. Well, that is Florida specific. They may have some real distressed sales. I think Texas might have some similar ones, but not quite the same, because they don't have all of those issues. They just had too many people flock there, and I don't really see them as the destination place as a place like Las Vegas, where we have a lot of things and I've seen the same inflow of people, but I don't see us having the same problems. And we're still growing as a city, and we're so close to California that's so much more expensive and has so many more taxes, that I still see a desirability as to why people will continue to move to Vegas. Uh, so each state, each city, each county, wherever you are going to be its own little markets involved in the overall market. So I don't really see mortgage rates coming down a whole lot, but I don't see the real estate market collapsing either. I see in some areas some opportunity, and I see other areas that there probably isn't. And then one thing I wanted to get to, because a few of you asked me about my thoughts on Boeing at this point, because I've been talking about Boeing a lot. Keep in mind, I own Boeing from I think around $172 a share. I am not getting out at this point, but I don't know if I'm right or I'm wrong. Like, markets are markets. I'm right a lot of times, but I'll also take it on the chin and admit when I've been wrong. Short term, I've been wrong on Boeing. I do think there's enough negative sentiment when it finally avails itself and gets out of the way. That creates the ability for it to go higher. What I really think is, when the strike ends, I'm hoping that's the low. And what I point to with that, what goes through my head is, when GM was having all the problems and Ford and all the others of the union workers striking against them, it really drove the stock super low. It sounded really scary in the news. And when that finally ended, was pretty much the bottom for the stock. I'm hoping this is the end for Boeing, that over the next month or two, or possibly shorter if we're lucky, possibly longer if we're unlucky, that the strike weighs on it, gives it one push lower to the downside, and when they finally come to an agreement, because they will, I'm hoping that's the last thing that's negative on the company, and it allows it to go back up. Now, I didn't really watch Ford, and I don't watch Stellantis. I watch GM because we have a tiny bit in our portfolio, and after it made those lows, it's pretty much doubled since then. And I'm not saying that's what's going to happen with Boeing, but I just feel like once all that negative sentiment gets out of the way and all the sellers are done, you get to this point where you only really have demand for it to buy, and they do the best not to just drive the stock up too fast. Look at CrowdStrike. Now, it was on a much tighter time frame, but they had that bad news. The stock went down from, I don't know, maybe $350 a share, all the way to under $200. Once the sellers finally finished, my God, the stock still has some down days, but go look at a chart. It closed right around $300. I think it traded $200 less than a month ago, and now it's talked about a lot less. It's not the negative news anymore. Now, I know that was a lot shorter time frame. I know that the negative information was a lot, different, but same concept. You look for those opportunities of the bad news, and you do your analysis of, do you think that's going to continue forever? Do you think it's going to weigh on the stock? Do you think it's real and the stock's going out of business? My thought is, Boeing is something that we need. They've got government contracts, and they also do the planes that you and I fly on as well. I don't think that there's so many out there that we can just get rid of them and put them out of business. my guess is when all the negativity is done, they're a good company that just is going through this transition where things need to get fixed. May end up like an IBM or Disney where it takes a lot longer than I expect, but I'm not looking to sell it. It's also not such a huge position in my portfolio that if it doesn't do well, that it's the end of the world. But I did put a decent amount on. It's not like I don't care about it, but I try not to make any bet so big that it's such a major deal. But I still believe in it. I still have the same bet on. Now, I do question it myself, not just with Boeing, but a lot of companies about sometimes I try to think about why don't I just pick my top 10 and put 10% in each of those stocks and not even pay attention to the rest, because my hope is if I pick my top 10 that they outperform the market. So why do I worry about anything else, and that maybe I don't own Nvidia in those top 10s and I've missed out on a great opportunity. I go back and forth on all of it. You might have watched my video about, investing in the SPY and the QQQ is almost like cheating. In some ways, I've thought about that as well. And I even made my list of my top 10, which I'll share in a minute, in terms of thinking, geez, maybe I should go that direction and hone down on, I think I have Dow, DOW, and I have not Cisco. I really like Cisco, but I have Cisco too, and some others that I don't know that I'd put in the category of being in my top 10. I think of them as great companies, but not necessarily like the best of the best. So I even question myself about why waste time with those. I think they spread me out and they make it a little bit more of a safe stock account, because the reality is most of the ones that I think that way of, like Pfizer, for example, are the ones that I think in a down period are going to hold up pretty well and probably be able to pay their dividend. Bristol Myers as well. Even UPS that's been out of favor, I bought it because it's been out of favor. And Target, for example. Like, should I just get rid of all of those and move anything that's retail into Amazon because I think Amazon's the best? I don't know. It's not some straight answer of yes or no. But sometimes I think if I get a little more pointy in the portfolio, it gives me an opportunity to really crush the markets. When I look at like Bill Ackman, I think he tries to limit how many stocks in his company down to like 7 stocks and really go super strong in those because those are what he believes in. If I spread out too far, which is what I tend to do, I tend to mimic the market, which is just fine. But if you really want to outperform, are you better off doing the top 5 or 10 of what you think? Let me know what you guys think. What do you do in your accounts? Even when I picked my top 10, I don't know that they're all my top 10 because I wanted to get some in each of some of different sectors that weren't all technology. So here's what I had for my top 10. Meta, which happens to be my largest position, I put as number one because it really is one of my favorites, because I think he just is a cash cow and everybody seems to hate Mark Zuckerberg, which makes me love it more. Um, Amazon, Google, Tesla, Apple, Costco, Intuitive Surgical, Starbucks, and then I put Chevron and Exxon kind of together, and NextEra Energy. And I picked those because they spread across some different sectors. They're the ones I think are the best of the best. And Tesla and Costco, I own less than 1% of my portfolio, like just to have it on the screen. But I do think those are the best companies. It's very hard for me to buy Costco where it is currently. And Tesla I was able to buy really well recently, but when it had its run up, it moved so quickly I was all too happy to take the trade off. Am I better off just buying those 10 stocks and never looking back, just thinking I think those are the best of the best? And if one or two doesn't do well, I think I should outperform. Or should I really buy and spread out and have 20 or 30 stocks? Let me know what you guys think. What do you do? Anyway, like always, do me a favor if you haven't already, hit that subscribe button, smash the like button. Tell me what you guys are thinking this week. Did your portfolios hit new highs? I hope they did. I mean, the stock market's been really running, and I don't think it's going to have any big crash. I think the fact that the Fed cut 50 basis points is an indication that they're going to move closer to where the Fed funds should be sooner than later. I think that's going to spur the businesses to be able to spend money and start growing. It's really amazing. I just hope it doesn't spur inflation. But from what I'm seeing between my friends and work and everything else, I don't think it is going to spur inflation again. I think it's going to drive the economy to be strong. And one last thing to all you gloom and doomers and all the videos you put out, please stop. You're really causing a large portion of society to stop saving, put their head in the ground, and be depressed and blame the government and their bosses and everybody else. Get them on the path of saving and investing and just working hard and trying to achieve what they want. Life is really hard sometimes. I mean, it's really hard. I don't want you to look at me and think, oh, it's so easy and whatever else. I was talking to my son about it, and one of the things they talked about in Rich Dad Poor Dad is anybody who's done well, they've had big failures as well. I've had a couple of restaurants over my lifetime. The first one I ever did was a huge failure. I spent a lot of money. I focused on the wrong things. I didn't understand the business. I lost a lot of my money and was in a very tough position. And this was happening right around 2008 when the economy was collapsing. We all have our ups and downs, but you kind of do your best to get your head back on, focus on what you want to do, and continue to drive. Even me, who's at a point where I probably could just put things in dividend stocks and retire and downsize a little bit. I'm talking to a friend about two different businesses and opening those just because the game continues to be fun and I want to see if I can succeed at these things. Two industries I've never been in. But what I'm trying to focus on is setting them up properly where if we spent a year in Japan, they should be able to run. Paying employees a little bit better, having a manager on site who maybe has an interest in the business, and that they're able to run it like a corporation. I don't know that we'll pull it off. I really don't. But it's fun to see if we can do these things. And like I said about like not having that attitude of I can't, trying to see like what do I need to do to try to make that to happen. Now, I don't know that I'll do it, so please, when you check in, it's like we haven't followed through on the business. Maybe we ran into some issues that we decided against it. But just the point of getting the mind out of that set, like I can't do this or I can't do that, I can't get out of this predicament. And I understand when there's no money and things are tough, it's hard to see that vision of what one needs to do, but just looking for solutions and seeing what can I do to change this. Have a great week. I'll try to put some stuff up during the week and I'll talk to you guys soon.